Hello, it's Patrick Barlotta. I want to jump back into our series and give a quick introduction to ratios themselves. So, in the next couple lessons, I'm going to cover specific ratios across these categories, but I thought right now it might be good just to talk about ratios. First, why do we have ratios and metrics? I want to use those interchangeably. So, a metric is just a way of representing numbers, amounts, financial things that change over time. Ratios, some things are specifically called ratios, but think of them as like numerical ways of looking at aspects related to company performance at a moment in time, over time, etc. Why do we use ratios and metrics? The basic idea is they're summary statistics, usually much easier to digest than raw numbers, and they give us a general depiction of how the company is doing. And then, obviously, what I think is most important is tailored to specific areas. So we have a whole bunch of them, right? More than I can cover in these lessons, but I want to highlight some of the main tools and then then jump right into kind of talking about some of the main ratios that we're going to see. So let's see. First, common sizing. You've already looked at financial statements. You've covered the prior lessons. That's not new to you at this moment. But common sizing is a technique we can do commonly, actually just easy to do it in Excel, but with a set of financial statements specifically, you can do this on the income statement and the balance sheet most commonly. So what do? On the income statement, we take all of the items and we divide them by sales. It's just a nice way of looking at things as a percentage of sales. And it makes it easier for us to look at changes across time. If you took something like cost of goods sold or cost of sales, or percent of sales, it'd be much easier to just look at it as a percent and say, oh, it's 74.2%, and then it went up to 74.8%. We probably couldn't process that in just looking at the raw numbers, especially that small of a change. And the beauty of the ratio is, cost of sales went up as a percent of revenue. I can go and investigate what that is because I quickly see the math. So ratios aren't doing analysis, but they're a great starting point. And then I can go and flesh it out with the specifics going on, like what drove that change, because it helps us see the cost went up as a percent of revenue, which we may not be able to calculate with raw numbers. So we common size things on the income statement by dividing everything by sales. With that, we can look at how expenses and also profitability subtotals are changing as a percent of revenue. Much easier to look at, kind of a quick way to get a general understanding of what's happening on the income statement. We can do something similar on the balance sheet. Specifically, we can divide everything in that case by total assets. Total assets equal liabilities plus equity, but we just usually refer to total assets. If we divide assets by total assets, that should give us an indication of like what was important to us. If you're talking about a retailer with a heavy brick and mortar presence, you should expect at least two assets to be a larger or a meaningful percent of sales: inventory and property, plant, and equipment, because that's what the core business is. So it's a good way to test out to see if we can confirm what we thought or a hypothesis about the company. Do we expect them to have lots of inventory, have sales on account, have intensive capital intensity, so they have a lot more fixed assets like property, plant, and equipment? If so, then those items should be a larger percent, not as a total dollar amount. That's not very useful, but as a percent of total assets. So restating this, common sizing on the balance sheet on the asset side gives us a general understanding of, in proportion to the other things, which assets did we invest in? Or you could say it in a more fancy way, where did we deploy our capital in this specific assets? And that should be related to what we do as a business. All right. We common size on the other side of the balance sheet as well. What we do there is we're going to common size liabilities and equity by assets. And what we can look at there a little bit is like our first lens into how are things financed. So like what percent of our liabilities of total assets gives us a general idea of like what percent are our assets financed by liabilities? What percent are they financed by equity or kind of a part of our ownership? So if we do the liability and equity side of common sizing, it's giving us an indication of not what do we have. That's only on the asset side. But in many ways, how do we finance what we have? By looking at total assets, looking at liabilities and equity as a proportion of total assets. All right, my next one here, cross-sectional analysis, common term worth understanding. It just means we're looking at a moment in time, usually a fiscal period, quarter, a year, but we're comparing that across companies. So we're holding time constant. We're holding the specific year, the specific quarter, the specific economic conditions constant. And we're saying, how do different companies perform? So as a result, cross-sectional analysis requires, one, we've determined the time we're going to look at, and two, we have at least more than one company to look at. So like at least two companies to look at. We could look at 5, 6, 2, whatever else, but we're looking at more than one companies. And there we're trying to say, look, we know this major macroeconomic thing is happening, or did happen, or this period has passed. How did these companies perform differently in that specific context? So that's cross-sectional analysis. Time series analysis would be looking at one company and then comparing it to itself over time. So if we're looking at, the last 5 fiscal years, the last 10 fiscal years, the last 16 quarters of a company's performance, and then we're trying to look at trends, conditions, are they profitability increasing, deteriorating, et cetera, that would be time series analysis. We're obviously letting time pass in terms of the reporting periods, but we're holding the company or the company under scope, the one we're looking at, constant. How has one company's performance changed over time? Time series analysis. Cross-sectional analysis. At a moment in time, how have different companies performed? And then some general categories, each of which I'm going to elaborate in the quick lessons that follow. Profitability, I'm going to start with what's on the income statement. There's different ways of measuring profitability. Well, there's lots of ways of doing this first and foremost, but there's even different ways within the income statement. So a good way to we covered this to a certain extent, we covered the income statement. I just want to talk specifically about the profitability metrics in the next lesson. Efficiency. Efficiency, we'll talk about, is actually a combination of the income statement and the balance sheet. In many ways, it's how do we use our assets, or technically also our liabilities, to do things. And so it has nothing to do with how much money do we make per unit of sales or something like that, but it is related to how we have assets. Like there are things at our disposal we can use. How efficiently do we use them, right, to generate revenue in most cases, all right? Liquidity. How are we doing with respect to specific current period cash flows or things that can translate to cash? So we have different metrics of looking at this. And this is extremely important if we're worried about our ability to stay in business for even a short horizon. Like, hey, are we going to be able to pay our bills in the next 30, 60 days? Well, we may not care about the long run performance and growth and everything else that we may see across the financial statements. We just want to zero in on, do we have any issues with paying our bills? And we'll talk about how we can use liquidity to get a quick assessment of that. Capital structure, also kind of a combination of the balance sheet, but we look there at what different ways do we have of assessing what is our capital structure, which is just a way of saying, similar to what we talked about with common sizing, the percent financed by debt versus financed by equity. And in that lesson, I want to bring in a few other ratios and metrics that can give us some degree of looking at company performance. Last one, solvency, and I put a question mark there. There's people who describe solvency with different metrics, actually kind of equating that to capital structure. And of course, your ability to pay off all of your obligations over time is solvency. So it's like, can you as a business stay in business now, stay in business over the long run, because you can pay off all of your obligations when they come due, not just the ones coming due in the next 3 months or the next year, but all of them as they come due. That's effectively what we're trying to get at solvency. But I want to jump in here just as a quick reminder of what is already a good metric of solvency. And that answer is, in many ways, if you think about it, I've mentioned this before, and I want to keep emphasizing it. What is the goal of your core business? To generate value for your customers, your revenue, and have expenses that consistently over time are less than your revenue. And if you're able to do that, which is just positive net income, right? That's your positive net income over time, not at one moment in time, not one quarter. That's not what I mean. But your ability to generate positive net income, meaning revenue, value generated to your customers, that's greater than the expenses incurred in running your business. That's the best depiction we have of solvency. Your ability to consistently have positive net income, generate more revenue than your expenses. Which expenses? I'd really argue all of them, right? So that's where completeness may work well. Covering that one up front, I think is a good way to think about it. So we have different ways of measuring profitability, efficiency, how you're performing, your capital structure, et cetera. But I don't ever want to lose sight of what I mentioned in the last one. Still, at the end of the day, what's our goal as a business? To generate enough value for our customers' revenue is greater than our expenses incurred to generate that revenue, and do that period after period after period after period after period. Not only is that a good lens to think about in running a business, but on top of that, that's really what we care about once we get put on our hats of being an analyst, doing valuation, et cetera. Any of those other kind of tasks that we have, we still want to emphasize the importance of understanding, what do they sell, what are the expenses they incur, and how do those work out over time. So more to come. I'm going to wrap up right now. Take care.